Oil prices collapsed in the United States yesterday due to the ongoing problems of excess supply of crude as the coronavirus pandemic restricts movement globally. This follows a drop in demand of more than 30 million barrels of oil earlier this month. Oil and gas markets have been experiencing an especially trying time as demand for these commodities continue to stall, bringing this particular economic activity to a standstill. Joining us via Skype now is energy expert NJ Ayuk. He is the executive chairperson of the African Energy Chamber. Great to have you, NJ. Thanks so much for joining us on the program.
Thank you for having me. Good morning.
It's an absolute pleasure. So, in recent days, we saw oil prices looking a little bit more positive, but, it was obviously short term. What caused the sudden collapse again yesterday?
I think it's still on demand issues. I mean, you have to look around the United States, look at Europe, at Africa, and you have to look at China, still on lockdown. Demand is very, and the market is skeptical. So right now we see the markets not reacting to the open spots because they've not really taken effect. Let's wait and see what happens over the next 4 days. So let's say Monday we'll see an uptick in the market.
Okay. For the layman, explain to us why the storage of fuel has now caused such a problem. I mean, to the point that we actually saw WTI going into negative territory. You've never ever seen that before, literally paying people to take your oil so that you can make more space. Talk to us about this.
Well, put it this way. You have so much oil in the market. There is so, after the coronavirus kicked in, you had demand very weak. China used to take a big part of the oil and gas from Africa, from the United States, from the Middle East. Right now, no more. So what happens? Corona hits, your airplanes stop flying, everybody's on lockdown, you cannot drive, the prices are weak, so there is more oil in the market than we actually need. So the price goes down. But also there was a second factor. You had the price war between Saudi Arabia and Russia. They are very close together, but they then started the war share, and that really hit the market. So there was more oil, and there continues to be more oil than you currently need. Right now, you were seeing about 30 million barrels being produced per day when the market only needs about 18 to 20 million barrels. So we have an excess of somewhere around 15 million barrels in the market, which has to change. The good news, though, the OPEC and non-OPEC countries got together. They had a cut, and this cut could go up to about 15 to 20 million barrels. And if they could help stop the supply glut, and that there's no much oil, there's not a lot more oil in the market, we might see an uptick in oil prices, and we might see an uptick again. But again, we have to look at the fundamentals, and market forces are really going to determine, and the coronavirus is a big part of that.
Yes, I mean, we saw the beginning of April a series of discussions between, as you mentioned, Saudi Arabia, Russia, as well as other big oil producers, resulting in announcements to actually cut the oil output. But most analysts said that, it's not likely to bring any substantive, let me try that again, substantive yields. What's your opinion regarding this?
I think you're not going to see a big spike in prices going when we look at WTI, for example, going into the high positive of 40 or 50s, or Brent, which most African crude is based around Brent, going right up into the 50s very soon. That should happen somewhere fourth quarter this year, or possibly first quarter next year. But what the market really needs is stability. It's not a big uptick and saying the price is up, let's all go hurrah and buy. But what you're going to see is that the goal of OPEC is to stabilize the market, because volatility is one of the worst things that can happen to this market. So I think, yes, it's going to pick up. It's going to be a gradual pickup, but until the lockdowns stop, airplanes start flying, people start moving, manufacturing picks back up again, because factories are really big component part of this. So if we start producing more, driving more, flying more, you are going to see an uptick in the market. That is what we have to be looking at. The economies have to start moving again. The world economies right now are shut down. And so even the oil industry also faces a hit when this is happening.
I mean, it's a good way of looking at it. But another issue is what about African countries whose economies depend on oil, but obviously don't necessarily have such huge reserves? Where does it leave them?
Well, African countries whose countries depend on oil have to really deal with big issues right now. And I think that is really what is happening, because most of these countries are really struggling and everything. But when you look at what is happening in Mozambique, you look at Nigeria, you look at Angola, their reserves have been really hit. And they are right now struggling. And some of them even going to the IMF or really going to the World Bank for loans. And that is where you see most African countries stuck right now.
Something like British Petroleum or BP warning of a shock that's never been seen before. Help us out. Explain this to us. I mean, what are the short-term and the long-term effects of this? What does that impact look like?
Well, for example, British Petroleum, BP had a big project coming up in Senegal. They were going to put about $20 to $30 billion with some of the largest LNG fields there. They've postponed that. You had same thing in Mozambique, but right here in South Africa, Total had a big discovery which could see about 1 billion barrels of crude condensate coming upstream, which could really help in shaping the country's energy mix right here in South Africa. Now there are big questions about that project going forward. And when you look at all of that, we have to get back to the basics. The basics is jobs. Jobs for everyday Africans, jobs for everyday people who don't trade in the stock market or they are not on Wall Street. But we have to look at Main Street. And that is what most Africans are really dealing with. Contracts being canceled, those who build small hotels in all cities like Maputo or going into Luanda, Angola, or Port Harcourt, Nigeria, or Dakar, Senegal. They are losing that. And some of the great projects that people were looking at happening around the Mossel Bay or looking at the KZN in South Africa on that oil strike, it's going to be delayed. And that is what we're really dealing with. And we have to see that change and ensure that change happens real quick. I am very optimistic, though. It's going to bounce back. The oil industry has seen worse. And Africans have seen worse. We're resilient, and this industry is part of us. So we're going to see these projects coming back. They're not canceled, they're delayed, but it takes what government and us have to do to boost back the economy. Sometimes not just money, but it's also what we need to have a common sense agenda to really drive this up. For example, giving them extensions, shoring up, creating an enabling environment, ensuring that we waive some taxes or delay some taxes for payments later, and really create this industry to breathe again so that we can use our natural resources to better everyday Africans, because that is what this is really about.
Just finally, and very, very quickly as we wrap up the interview, do you think this is going to have a positive effect on renewable energy? Because that's been, spoken about for such a long time. Will this see this industry moving even faster?
No, it's not, because the market is not there. When the market is not there, you're not going to see renewables happen. You need to see your renewables have to be competitive. Let's be very honest. No bank is going to finance or fund a losing project. Banks want to make money, so renewables have to be bankable. And if the market is taking a strong decline, it's bad for renewables. So we need the market to pick back up so that we can have a whole complete energy mix, and renewables have to be that. And one more thing before I close. It is time for African countries that are really focused on petroleum resource and gas to start thinking about diversifying their economies and build a bigger base where you can use your gas or your petroleum to create urea, ammonia, NPK, fertilizer plants, and really transform the economies to really push things back up, just like what China is doing. We need to use those natural resources to boost our manufacturing base and make us a more stronger and resilient economy by building our energy infrastructure. But renewables have to be part of the mix. It's not either or, because this is time for energy transition when you look at climate change and everything, and that is where we're going. And we need to pay more attention to that. We cannot be held back or stay last and wait on Europe or America to come bail us out and drive us there. This is our time to lead, and we need to lead.
All right, MJ, thanks so much for talking to us. We're going to let you go and give your little one a cuddle. She was looking for you, or he was looking for you, but earlier it sounded gorgeous. Energy expert MJ Ayuk, who is the executive chairman of the African Energy Chamber, discussing the impact of the plunge in oil prices and implications thereafter. I have to say, I was a little bit sad the little one didn't run into the shot. I was looking forward to seeing him. All right, let's take a break. After this, talking about little ones, schools are under discussion. Do stay tuned.